Hi, my name is Roy Idrak and I'm your facilitator for this Wilson County Library classroom. So this morning we're going to cover the final part of lesson number 1 for the investment seminar. So I see you on the other side at the classroom. Good morning. Welcome to the Sanford Junior Library Seminar, the online investment seminar, and my name is Roy Idrak, and I'm going to be your facilitator. So this part is the last part of lesson 1, and then we will continue with lesson 2. So let's get and see what we got coming. As you all know, the seminar is on a free weekly seminar. This is our 3rd year. It's by internet access only via the library channel. So you need to register. I'm very sure you here, you already had done that. Any question, make sure you direct them to floresville2018@yahoo.com and be online by limited time and limited access. So make sure you register early. Okay, so here we are in the classroom, and we're going to discuss this morning several topics about charts and different activities that take place when you're trading. So let's continue, and remember, on the past we talked about we've been conditioned, just like the little grasshopper there, right? You get trapped into the jar, and then you get used to it, so you've been conditioned, then you can take the lid off and it won't go no place. We are raised on the same form. We kind of follow what our parents do and what society do. That don't mean that it's the right thing to do or the wrong one, but it depends on a lot of things. So the system, you're born into it and you get used to it, and therefore you've been conditioned and you don't even question it, why the system is like that. And I mentioned it before, if we talk to a person that may be 20, 30 years old, that he born and raised in Cuba, and he been there all his life, he don't know nothing but what is in there, and for him, everything is, everybody out of the world is okay, and this is why the dictatorship control them, to make sure that they don't have no knowledge of what's going on outside of that world. So for them, that's the way it is, and they get used to no problem. Their great-grandparents back from the 50s and the 70s will have a different opinion, and so on. So we are creatures of conditioning. So I thought you review some of that we had covered before. We also talk about the price, income, and discrepancy, in salaries, when 90% of the society and the working class, 137 million families in the United States, make less than $31,000. This is an agenda that I have that I don't think is fair, but part of it is our own fault, because we rather follow the crowd and do what everybody else do, and it so happened that they happen to be the wrong one. So think about this. When society plunders, become a way of life, we ourselves create, we create for ourselves a legal system that authorizes it, a moral code that glorifies it. So this was written by Frederick Bastiat, and how true it is. Sometimes politicians plunder the treasury of the country, become a way of life, and we think it's good, and we go along with it. We glorify them. We vote for them. We allow them to steal from society, and we give them credit too. So nothing new. This has been going on forever. So here's, you've been conditioned. You are part of the big crowd, and what we want you to do is to move to the 90%, to the 10%. You need to get out of the 90% group and move into the 10%, because these guys are wrong. This is the problem. On this group, we do everything wrong, and here is where we can get ahead. As we mentioned before, this is how it goes. To be successful, you cannot follow the crowd. It's just that simple. I'm showing this example where everybody wear the same tie, same shoes, same briefcase, and there's just one oddball over here, right? Oh, boy, this guy is really different. He wear red shoes, white shirt, red briefcase. You need to be different. You got to do, by different means, you have to do the opposite what everybody else does, because they happen to be the crowd that is run. And then by the time they retire, they become a dependency from the state. They cannot support themselves without the help of the state, because through their life they did everything backwards. And this is what we carry here. So think about that. Here's what we're going to continue now in our class, the final one, on the Declaration of Independence, which contains oft repeated phrase that all men are created equal, was written by Thomas Jefferson, who owned about 200 slaves. At the time, he never set any of them free, even upon his death, right? So Jefferson said that all men are created equal, but, well, he was a slave owner, and today when we look back, this is some of the stuff that goes through our history, was brought in through the Spaniards. They start bringing people in from the Portuguese, catching a slave from the coast of Africa, and selling people just like they were merchandise, So it got the origin way back in Europe, Jefferson's words certainly has no reference to the black people. He didn't say nothing about them, of whom the majority of the time has no place in American society except as property. This is come from Wikipedia. But here's the deal. Notice what he said. The majority at that time had no place in American society. In other words, there were some slaves that they were prefer or have a position that they were treated different from the other one. Maybe the guy on the plantation was in charge of them, that he also was part of the group, So he was treated differently than the people that did the work. Well, back in 1972, I wrote a book, This Way to Success, all right? And in that book, I wrote something different about it, a new definition of what all men are created equal, and what Thomas Jefferson writing was in regard to time value. When Thomas Jefferson say that all men are created equal, he didn't mean about born with a gold spoon or silver spoon in your mouth. We got plenty of those, and they got some good example for you. Build churches from Church's Fried Chicken. His dad created a large corporation. He was raised, you could say, with a silver spoon in his mouth. But when he took over, he brought the company down to zero. He ended up selling it to Popeye Fried Chicken from Louisiana, and he gave everything he had to the Scientologists. So there you go. So not because you're born with a silver spoon in your mouth, that means that you're going to be successful. There are plenty of cases of people who started from the garage. They are major corporations today, including people like Apple, Facebook started from a room of the university, So what I'm saying is that we all have the same amount of time, and that is 24 hours. This is when I explained that when all men created equal, the meaning was in time value. Everything else in this world have 24 hours. My cat, my dog, time is 24 hours. Everybody has the same amount of time. Therefore, what you do with your time Value will make people rich or poor in the scale of sufficiency. If you don't care about what you do and you burn your time killing time and watching TV, while other people, instead of watching TV, they go to school or they learn something or they better themselves, but they stand the reason why they can get ahead and you don't. It's just that simple. I remember when I used to wash dishes, and there were people there, we were getting paid 35 cents an hour. Well, at night I went to school, and some of them at night went home. 3 years later, I became a mechanic. I go and visit the restaurant. They tell, what do you do now? Well, I'm a mechanic. How can you be a mechanic? You see, they're still there washing dishes. Because what we did with time, and that's what I refer. So time value is what make all, for me, is what make all men equals. And what you do with your time is what's going to depend whether you're going to be successful or not. So when you come to the stock market dreaming about becoming rich on the stock market without putting the effort or learning how to read charts, what is not going to happen? You're going to be part of the 90%. And I'm asking you and begging you, I don't want you to be part of the 90%. Now, let's see here. There's a question that comes from the classroom, once in a while we get questions and we go through a class. So let me give you one here. This gentleman asked, what candlesticks tell us and why is so important? And we're going to study charts. We're going to use a type of chart that they use candlestick, and we discussed that more in detail during the class. The first lesson is about tell you what is going to be into the entire course. So this is lesson 1 is kind of a preview of what you're going to see down the line that we are going to explain, and I'm going to explain in more details. For example, let me say that it's the story of time change in a price at interval of time like second, minute, hour, daily, weekly, and monthly. So you can have charts that can be done by the minute. You're going to have charts that can be done by hours, month, daily, week, and each one tell us a different story. And this is what chart is about. So when you take a chart and use the candlesticks and combine them with indicators, it will give you an idea of what's coming from the previous history. History has tendency to do what? Repeat itself. And we depend a lot on that. So you're going to see many patterns I thought that repeat and repeat and repeat. And this is how you make your money. This is how you make your investment. There are different kind of trader. I'm going to tell you that lately I'm a day trader. I'm very successful at that. Not everybody's cut to be a day trader. Some people make investment in long term, short term, mid term, but it don't matter. The chart is the same based on the time that they're willing to invest. If you are a long-term investor, you will use daily and weekly charts, while me as a day trader use 5-minute charts. The information that we put in it is the same, but I'm doing it in a much shorter time. I'm not looking into 6 months from now or a year from now. I look at what's going to happen today, and that's it. Not everybody's cut for this. Let me tell you that right now. Now, here, for example, is this chart is of Valero Energy. Some of us are familiar with them. It used to be the company called Diamond Shamrock. It started from a very humble service station on Commerce Street down in San Antonio. One man attendant, he was the owner, and then he became a large corporation. And eventually he sold it, he got took over by Valero. Another example of what you do with your time. So let's look here. When we talk about chart, this is a daily chart, and we're covering, almost a full year in here. And what I'm going to show you here is something that we're going to learn. We call these channels. Other people call it, well, you don't do nothing, the market is flat, and so on. But this is the price. We call it a channel because the price goes nowhere. It goes up and down just in here. Two things I'm going to tell you right now. So here we go, 4 months of flat movement on the market, very little movement. And when you see that, you need to be prepared for one thing. Either the price going to go lower or the price going to go higher. It's going to break out, what they call breakout. So the breakout going to be either up or down. We don't know yet, right? So we're standing over here watching, standing by the fence, ready to pull the trigger. When you say pull the trigger, mean we're going to buy or we're going to sell. But it's a terminology what we do, the language, the lingo for the market, like being naked or being covered by when you buy and sell options. That we cover that later on. So notice that we wait, and every time, this is something that happens very, very often. The stock goes up for a long period of time like this, like Advanced Micro Device, I remember used to trade at $2 and $3 a share for over 2 years. I saw Valero at one time going for $18 a share for 2 years before it broke out, and this is part of that breakout, it's already at 70. So here we go, and then you get a trend. This is a trend. The trend is up. The same way that we got trend up, we also got trend going down. You will see some of them later into the class. Then here we come in another flat channel, right? It's a channel, and if you draw a line over here and you draw a line at the bottom, you notice that the price only zigzagging up and down between that. This one took 2 months rather than 4 months or 5 months, right? Again, the same thing going to happen. Either going to go down or it's going to go up. However, since we are in an uptrend, we expect it. We are expecting it, right? We don't know. We're expecting it that will continue up, right? Because we establish a trend. So this is a trend that goes almost for a year on the upswing. However, this part here, after the price go from 70 to almost 100, is a $30 move. In 1, 2, 3, 4, 5, 6 months, the stock had moved $30. And then there's a accumulation time. It rests, kind of indecision. Well, we'll continue to go up. People that are going to take profit. They take the $30 a share, and they have 1,000 shares. They make $30,000 in 6 months. That's more than some people make in a year, or twice as much of people that work on minimum wages. So it's a good deal. But we got to remember there are people that also have millions of shares, and we can tell that by this, right? You can tell here that we traded on this day about 6 million shares. So this thing trade daily in the millions of shares. So there are people buying millions of shares out there. Some of them buy 500, some of them buy 1,000, other people buy millions. And that's the way it is. So a $30 move on a million shares, that's a $30 million profit for somebody in 6 months. So we had to deal with a flat channel, and then the trend goes up again. Now, when we combine those things with different indicators, and we're going to learn about all these indicators that you see. This is just a preview. Remember, lesson 1 is the final part of lesson 1. And we're going to take piece by piece all these different indicators, and then you choose the ones that you feel more comfortable with it to work on it. So that's kind of flat channels, trends, and so on, to give you a general idea of how the market behaves. Now, here is a candlestick, okay? And the candlestick, we discussed this before. We got the lowest price of the day, the highest part of the day, the opening of the market or the closing of the market, Is it going up? This be the opening. Is it going down? This is the opening price, and then the price go down. The body can be in red or black. Close lower, body in white or green. Is it close higher, right? We got one here in red, and we could say that we open what? The date is the 27th of June, 2018, and it opened at 111.21 right here. The high was 111.93, so this right up here at the top. The low was 110.25, which is way down here on this area here. And the close was 110.44, that it closed here. The volume, there was about over 1 million shares traded that day, and the previous year was 111.07. So from 111.07, we go to 111.93, at the high, but the opening was 111.21. So it was a little bit higher. So at one time, this candlestick was green, and then it started moving down, and eventually became all red. So from the high to the low, even so, was higher than the previous day before. The candlestick is all red because it finished lower. Even so, at one time, it was a little bit higher than the day before. And of course, the volume, is probably also, I would say, 1 million. It was the total amount of shares that was sold by the day. So this is what the interpretation on the chart when you see open, high, low, close, volume, and yesterday. In other words, the white for yesterday, day before. However, think about this. A lot of things going to happen in here that you don't see. All you're seeing is a daily chart, which is this one right here. The price goes up every day. You get 1 little bar in there that comprise of so many hours of trade. I think it's 6.5 hours of trading during the day. Since I'm a day trader, I need more information like this, right? I need stuff by the minute, about 5 minutes to see what's going on. So let's look at this. We have over here Facebook, and this morning it opened at 711 is the amount of money that we're dealing with from it opened at 155.21. See, however, from the close before, we're dealing with about up, it's a $7 move in here from the day before. So it opened at 155, but the day before, previous close was 148.10. So we got about $7.11 on the opening up. So if you're a day trader, you will not be able to enjoy this, right? Because by the time the market open, unless you bought it the day before, you won't be able to make those $7. All you're going to make is from 155 to 161, which is only $5.77. This is what I got in here. But here is the chart, and what we comprise now is to use this chart and a daily chart and break it down on what happened on this day, on the 23rd of February. This is Exhibit 8, Facebook daily price for March 24. It was a Tuesday, Monday Tuesday, and then we got Monday the 23rd, right? So March 24, 2020 on a Tuesday. This is the 23rd, and this is the 24th right here. We amplifying the chart. We making this little rascal on the 24th bigger. We zoom in the bar so we can see what happened during the day. So we see that it opened when? It opened at 9:30 in the morning, right? That was the open, 155.21. During the day, and it was 9:30 during the day, the low was 152.57, but it did not happen until 2:15 in the afternoon. Just think about this. When we look at it without breaking it down, we will know those things. We just know that the previous chart that we were looking at it, like this one here, We knew that the high was 111 and the low is 120. 110.44, and went as low as 110.25 and the high of 111.93. But we don't know at what time those prices took place. So we're going down in more details and see that it took place when? 9:30 in the morning, we knew that it opened at that. We knew that the high was 161. We knew that it closed at 160, and we know that the low was 152.57. We know that, but what we don't know is at what time it's happening. And this is actually what happened. In the morning, when the market opened at 9:30, it opened at 155.21. The low that was 152.57. At what time it opened and closed. So this is what transcribed during the day. Now we're going to break it down into by the minute. Okay, so this is now by the minute. The candlestick chart by the minute. The price open on 155.21 is right here. And we know that it opened higher than the day before by $7.11. And then the market take off. And here we go, that this is A, 155.21. That way we got a little line there. This is what it opens. But inside of this, all these things happen. In 7.5 hours of trading, we got 450 candlestick here in minutes. So price has changed during the day all this much. And when you are a day trader like me, then you look for opportunity to probably catch a price here at 2 o'clock in the afternoon at 152, and then to sell at 161 or close to that, right? So it's about 152. It's about $9 move over here during the whole day. So the market opens, it goes up and down. The low of the day, this one right here, and this the same thing, B, we just amplifying this even bigger. The low took place at what time? Right in here. Look at the clock. Right? The low happened at 2:15 p.m. And we know that the high, it happened at 161, and it was almost at 3:55, 5 minutes before the closing of the market. 5 minutes. So we know a whole lot more now when we break it like this than just looking at the whole candlestick. So the high took place at 161, and then the market closed what? About $1 or less, 160.98, which is D right here, 160.98 at 4 p.m., which is actually this part right here, just below that D. So we close and the low. So now we know that at 3:55 we had the highest. We had that when the market opened, it opened at 9:55. At 9:30 in the morning, it opened at 155.21. During the day, at 2:15, that's when we hit the 152.57. All right. And the high happened just before and eventually closed here. So it was a lot up and down here. So this single bar chart here, this single candlestick, encompass 450 minutes of trading, or 7.5 hours of trading, and this is how it went. So you get a better picture when you do it by daily. Now, if you're a day trader, this is what you're going to be using: 5 minutes, 10 minutes, or 1 minute chart. If you are a long-term investor, then you don't worry about this. You're only interested on a bigger picture, like we showed before. But we're going to cover all this in detail in the class, but this is just a preview or lesson 1 to show you what is ahead. So here we go. Here's Valero. Again, like we saw different before, now it's $125. This is like several months involved. The trend, this is the trend. Now we put it in here between these two bars, and we notice that the price go up and down, but it's an uptrend. Then we get over here, it's gonna rest, and then we go into a channel trend. See? And then after 2 months of that, it breaks out again, and it take off and get from $95, it hit $225. I thought at one time this was going to split, but it didn't happen in 2018. I figured we were going to split. We discussed that in a seminar with the other class. It said it probably split, and they split at 60, but it never materialized. We're going to have here now averages. This is 25 days average. So this bar here that you see right here, the green one, is a 25-day average. This is a formula that is used. I take the price for the last 25 days, you add them all up, and then divide it by 25, and that's what it gives you. You see. So on this day, the 25-day average is 115. You know, even so the price 125. So what we're doing with this little bar, little line here, is taking the price for the last 25 days and divided it, add them all up together. You don't need to know the formula, but I'm giving it to you. You take 25 days and add them all up. Times 25 is done by you by the computer calculator. When I started on the 70, we had to do this by hand every day. So now with the technology, it's done automatically. So this is the 25-day average. The other one is the 45 days. So it's going to be lower than that. Then we got the blue one that is 85 days average. And this is the 200-day average. So they add up the price. So this is 200, 85, 45, and 25 days. We use that to give us an idea of where the price is going. So you can trade just by these averages and know that when the averages are flat, they just flat like this. This is what it formed that channel. You know, the price is divided and just it go nowhere. You divide that stuff, it almost add up to the same thing. You're like taking 2 times 2 times 2 times 2 divided by something, so you get by so many days you're going to come out almost like 2 again. So it don't going to go nowhere. Over here is a little bit different. So it breaks out. Notice that the previous chart, the same thing happened. It go into a flat and it drives up. Notice that the trend goes up and then take a little breath and rest when other investors start selling and take a profit. So you want to be longer than that, you stay there, or you can sell right here when it start doing that, and you don't get back in until it started doing this again. So you don't have to go to the pain of having all this money lost before you can make it up later. Long-term investors, they don't worry about those things. They only worry about the $200 day average, 200-day average. If the price cross the 200-day average, is telling you that we're heading into what they call bear market, a bear market. So they don't worry too much unless the price cross. This is why they use this, cross the 25. A day trader is more concerned about this here. So it crossed 10 days, man, he's ready probably to get out and sell. Here's the volume, like we explained before, 5 million, 7 million shares per day get traded just on one stock. And now we're combining, like I mentioned before, the indicator. We got less indicators here, right? We got the MAC, which is very popular. We got the RRG, with the, as compared to the S&P 500. And this is how you gather how to gonna buy. So if you are gonna buy the stock or you already bought it, the trend over here, the MAC is moving around, those lines are very close together, and then all of a sudden there's a warning here, and then it starts tilting down, you see, and it tilts down after 4 or 5 trades, right? So All the indicators and all this is based on previous data. So they always lagging the price. All these indicators lag. So by the time you see this turning, it's because the turn is already started. So it's not something that's going to predict to you what is on the future, because it can delay by so many days that it's been calculated before it tell you, hey, the price is going to go down. So therefore, what happens is that you never find the top of the market, you never find the bottom of the market. If you go out looking for the lowest price, you can lose a lot of money hunting for that. Notice that the indicator go down, and as it goes down, eventually, now we are here, and then it's move up in here. But since the price don't go on any further, it go flat, the line remain the same. Finally, over here, the line start going up. This is the buying signal. The green bar, the blue bar, and the black bar, they all start moving upward, but it happened right here by April 9. So you never be able to tell, they say, I'm going to buy it here because it's going to go up. There's no way to tell that. There's no way. You see, it's red, green, but we don't know if it's going to go up or down. That's why you have to wait. The signal is not telling you anything. The confirmation, if you use this, is right here. This run a little bit ahead of it. Notice that? Here you come in here, and about 1, 2, 3, 5, 6, 7 days ahead, this red line start moving upward. So you're getting a confirmation the price is about to change. The same way that you got a confirmation here, right, that the price is going to start going down. So some of them kind of lagging, they just warning you. You're getting the confirmation here that, hey, this is probably running out of gas. The confirmation comes right here. It's lower, right? And it comes almost close to that this is going about to turn. Then you get this RSI, and the relative strength indicator. It tells you if the stock is overbought when it's above 80, 0.08, some people say 80, and when it's oversold when it's below 20. There's only one problem with this. You can be oversold for a long period of time. So don't think that because this goes up in here, you say, my goodness, it's oversold, I might as well sell. Well, this can go for a long time. And here's a classic example. Look at this. We had gone from 95 to 125, and he said that it's oversold. So you have sold here, you will have missed all that. Because, it's going to fall. It's not going to fall. We don't know that. So a lot of guys that buy and sell a stock, they think, but you're getting it from the expert, 48 years doing this, that just because it's oversold, that don't mean that tomorrow the price is going to go down. Always remember that. You need other tools. You need this indicator. You need this one before you know that, now it's going to go down. And then it goes down very quickly, right? Because it get oversold right here. If you look at it on the 29 or the 20, 23, 24, it's already oversold. And it remain oversold all this time with the price going down, and then it tells you that it's overbought, but the price is going nowhere. You see, so it's not something that you can depend on engraved on a stone. It's oversold, the price is going to fight. No, this calculation take all these prices, and within this limit, it might be oversold or undersold, but the price is going nowhere. So you can depend more on this than anything else, but a lot of people depend on this. That's what I put it there. The other indicators that I put it extra in here I don't use it anymore because through the years I find out that they don't serve no purpose. And the less junk you put in this chart, the better you are. You get a clear understanding. Don't clutter your charts with a whole bunch of indicators. It ain't going to make you any difference. They all derive from each other, so some of the formulas are modified a little bit, and somebody now got a new indicator. But it's based on previous performance. Always remember that. It's previous performance of what happened. By the time the indicator reacted, you need the information from previous day. So this indicator is very good because it kind of starts decreasing ahead of time of the price move, right? It's a little bit more reliable. But you confirm, you say, hey man, it's going down, we got a trend down, even set the price up, I better get ready and sell. You get the warning here, and now here the sell signal because you got all three of them going down, right? And you see this, if you're long-term investor, you can stay there. If you don't mind losing from 100 to 90, $10 a share. So if you have 1,000 shares, that would have been $10,000. So it's all depends how many shares you got. If you got 500, you lost. Your portfolio had dropped 5,000. Do you want to do that? And then you're going to stay 4 months waiting before you go back up again? That is your own decision. As a day trader, I close all my accounts during the day, so I don't have to worry about that. I only worry about the price movement in one day. So with that, let's move to our next slide over here and see what we got. Okay, so remember we have a channel, and the channel created resistance and support. So the price falls so much, and then it bounces against that line, comes down, but it don't go nowhere. On a trend, you get the same thing. You get a breakout finally. Now we're moving up, and guess what? The price kind of bounce here, support, resistance. And now we got another resistance here, support, resistance. The price goes up, and then it gets this high and fall down and go close to this, goes back up. It tried to break down, and finally this is what they call a breakout. It finally breaks and start moving up. So you got to drop these lines. This is not perfect the way we draw it, but I draw it years ago. I get back on 2018. But it's to explain to you that there's a support. There's a support going on the uptrend, and there's a resistance that the price, for some reason, don't go any higher. So always remember this. You can take a snapshot of this and remember, right? Here's the signal going up, price going up. It tells you the oversold. Then it's oversold over here too, but it's oversold here, but it's going no place. So here, by the time it tells you oversold, you're breaking out. So this is Advanced Micro device when it used to be $16, $14. And I made this for the class in 2018 and told them that we're going to go higher. So we got in there when we noticed that Advanced Micro device had gone above $11, and he went into this channel and said, you know what? I told the class, this go higher. Today, 2020, December 2nd, 2020, Advanced Micro device is over $100. Think about it. You could have bought it for $10, $11 right here a year ago. And it be many up and downs. We have made some money with that. Right now, we don't touch it because it's $100. But the whole idea is the study and know about how much money could make on the stock. It wasn't in the channel for years. 2015, 2016. So this is over 2 years, a classic example of 2 years of the stock bounce around between $2 and $4. When you see this pattern, it's very important that you keep track of it, and two things going to happen. The price going to go up or it's going to go lower. So we find out that start going up, and here we are. It had gone up for so long that a year and a half later, 2 years later, from 2018, right? Here we are at 2020. It's $100 a share, almost 100. So the longer this trend takes place, the higher the stock, the more powerful gonna be the move. Always remember that. You can take a snapshot of that one too, or you can come back to the course and review it again. Now, let's look at this. The Dow Jones Industrial dropped 660 points today. What do you think it will do Friday, January the 4th? Okay, so is this a bear market or what? Well, we look at the price. Remember this line, the 200-day average? The price has been touching this. We've been going up, and then all these averages start turning downward. And the stock market at 22,000 is teetering on the 200-day average. And come back one time, it go down second time, it come back again, and then here we go, start going downhill. So we go from 25 to 2,200. So we got about 3,000 points. But this particular day, we dropped 600 points, okay? The question here is, lot of students, lot of traders, lot of investors made a mistake that when they see this one bar going back up, oh man, it went back up 300 points, it went back another 200 points, on Christmas days too. We come into 2019, so here we are in the 19, a red bar. This is what is called a bear trap. It fools people. A lot of people think that it's so cheap, or there's something else that we're going to talk about, selling short. If you sold stuff short, you need to buy it back, and it counts as an update. So if the people that made millions and billions of dollars on this trip going down, something that you need to know now, when the price goes up, you can make money, and when the price goes down, you can make money too. It's just, to us, it don't matter if the price going up or down. It's just to be on the right place and what direction. You're either going to be on the upside, or you're going to be right in here. If you're going to be on the downside, you got a short or buy put option that we're going to talk about it later. We're going to explain to you how you can make money with the price going up and how you can make money when the price go down. So for so off, there's no season. For us, for me, there's no season. We can make money on either direction. But this is what is called a bear market. And the reason is, right, that the people that sold short the stock, even so this is a index, you cannot buy an index, but you can trade on ETF that behave and on the index. But excuse me, you will see the same thing. You will see that the price start going up and you jump into it. And then surprise, you get caught, right, on a downside again. You're going to continue to go down. You're going to go down to 2,200 again and test that price. We are below the 200-day average, so therefore we are in a bear market. We don't come out of the bear market until the price or your stock or the indices go above the 200-day. And then you have to make sure that the indicators and everything else tell you. But right here, the signal came in. You look at this, and you look right here, and you see that the signal is down. It tried to break above zero, it don't make it, it remain down and keep on going down. So people that know how to read the chart carefully, you see this is already telling you that this is the game is over. We're heading down. It's time for you to get out of the market or short the market or buy puts, and write it out. let's continue with the next slide and see what happened. You have any question, make sure that you put it from Floresville 2018 at yahoo.com, and I'll be glad to answer for you. So this is now a more clear picture of how I trade today. This is the 200-day average. It's way down here, so the price is way above that. Notice that nowadays the chart that I use, this is a Twilio. It's a daily chart. I use these indicators nowadays, right? I use the PPO and the TSI. You know, I don't make too crowded, but you notice how the same as the other one, the signal comes in here, it starts moving up, and this is exactly what the price up. Notice that they also react late. By the time it's going down, we already going down a little bit from 320 to 300 before the line cross. So all these indicators have tendency to be delayed on it because depend on previous day's information, you know. So I shared this with you here, and we're going to study this more as we go down the line. Now, we're coming to close to the end of the lesson 1. We'll be moving very soon into lesson 2. And this is me waiting for my wife at the bank. I'm a character that I believe in smiling, making few jokes, like cannot be serious. You just want to be into the 10% that can make money. But I'm going to show you here a very interesting video. We are at the National Federal Bank, and remember, I'm 80 years old, so probably when I be about 90 years old, I will look like this on a wheelchair. I'm going to have my little coffee deal here. I don't trade anymore. And I got to go take my wife to the bank to make a withdrawal. So here I am on my little scooter, taking my wife to the bank, and I'm going to wait for her outside.
Is this your plan for retirement? Plan your future now with retirement.
Okay, here we are now, and we're going to discuss right quick before the end of this lesson 1 is about the true price of the stock, right? And this is how the price of the stock works. And then you're going to see a short video of how quick the price of the stock can change, you know, in the matter of minutes and seconds. So let's say that the stock is $100 a share, all right? And remember we heard about overbought and oversold, okay? So there's such things. So if you agreed like the company worth $10 million, and it got X amount of shares outstanding that they issue, you know, so if we all agree the price is $100, the price will not go anywhere, right? It's just $100. And everybody happy. Yep, the company worth $100 a share. Well, I want you to think about this. This is not always like that for the simple reason that price move all the time. It's very seldom that the price stays too long, even during the day, on one single price. Okay, so let me explain you what happened. When there are buyers, the buyers are demand. You gotta see that buyers are the demand for buying the stock, and the supply side, you know, there's a supply and demand. So the supplies are the sellers, those that are willing to sell. So in order for you to buy a stock, somebody has to be willing to sell it. All right? Remember that stocks, when you buy and sell a stock, it don't have nothing to do with the company that you're dealing with. The company got their money long time ago, and the company is not the one buying the stock from you, unless the company announce they're going to start buying a stock back. They might be buying a stock back on the open market. But otherwise, everything else is done on the secondary market. You buy a stock, you sell stocks, and you are the seller sometime, and sometimes you are the buyer, all right? And so when you're selling it, you are the supply. When you want to buy it, you want to buy it, right? In the middle of this is a market maker that decide how much you're going to pay for the price. Okay, so you want to buy the price and you say, well, I'm willing to pay $120, and you put your order that you buy it for $120. And think about this. If the price is up to $120, when you and I know that the company only worth $100 a share, therefore the stock is overbought. It worth, you pay more than what it worth. It's just like buying, you go to the grocery store and you know that you compare with Walmart, your local grocery store and stuff like that, and you notice that a gallon of milk costs $5. And you walk onto another store and you see that it's $7. So you say, well, that's overpriced, right? The price is too high. You know that generally you pay $5.50 for a gallon of milk. Same thing here. You look at the stock and you say, I know that it was $100, but now the price of the stock is $120. Where some people are buying, creating a demand that is false, and therefore you could say that it's overbought. On the other side, let's say that 2 weeks later, you see that the price is 80, and you know that the company is worth 100, and a lot of people agree, say, this is oversold. The price is too cheap. And this is why people sometimes they say, well, the price is down, that's what they buy. They buy when it's down because they say, well, it's cheaper. Even so, if they don't even know, but what they're doing is that the company probably worth more than that, and too many people got scared, start selling it, and drive the price down. Now, here what happened. When there are too many buyers, the volume drives the price up. You see? So there are too many people buying the stock, it's going to drive the price up. The market makers say, is there demand for the stock? I'm going to charge you more. All right? Then when there are too few buyers, right? When there are few buyers, what happened? If there are not too many buyers, when there are too few buyers, the price is driven down. Few buyers drive the price down of the stock. Because what? Because if the guy that wants to sell, he said, when I want to sell for 100, he says, sir, there's no buyers. It's just like you selling a house. And he said, I want $200,000 for my house, and that's it. You tell the broker. So the broker don't want to argue with you. He's going to put it on sale, and people calling, how much you want? They say, oh, well, they want $200,000. Oh no, for that price, I can get a better house than that for less than that, So eventually, 6-8 months later, you haven't sold, right? And you're gonna come in and jump about it, go to the brokers. Look, we're getting buyers. They come and see it, but they don't want to pay that. You're gonna have to lower the price. Let's take it $10,000, or take that, or whatever. So they reduce the price, right? So fewer buyers drive the price down. If nobody want to buy your house, it's because you're too high. Otherwise, it would have sold immediately if it was too cheap. But the brokers don't want to tell you that, because if he tell you that, sir, you cannot sell it for that price. In this neighborhood, this is what it's going for. He won't get you to sign the contract, so he's going to agree with you at the very beginning Not that I'm talking bad about realtors, but the idea is that there are a lot of realtors that they just write contract and they never try to sell the house. They sit and let somebody else do the selling, and they collect the 3% commission on the 6%. So there are people like that, and I know because I bought many houses. So I don't criticize anybody, but not everybody's honest on the business. Okay, so the same thing happened here. On the stock market, if there's too few buyers, that drive the price down. And when there are too many buyers, it drives the price up. On the other side of the street, right? Too many sellers drive the price down, right? There are too many people willing to sell, right? And there are too few buyers, so it drives the price down. Same thing with real estate. Too many houses for sale, not enough buyer. You know, you got to drop the price because you got a lot of competition out there. Now, when there are too few sellers, the volume of few sellers drive the price up. So there are people that want to buy, but what happened? There are too many buyers, right? There are a lot of people willing to buy, but there are few people willing to sell. It's going to drive the price up. So it's all in supply and demand. Actually, you can think about buying and selling a stock is an auction of buying and selling equities. So the option envelope, the opinion envelope is based on this. This is the true value of the stock, and then it fluctuates based on what? On supply and demand. So the price really never stays in the same place. So here what happened. We say that the price is, the intrinsic value is right here, right? The market is in balance. So the price don't move, just like we just saw here. With right here, true intrinsic value, $100 a share. And here we are. This is the $100 a share. The price is right. Buyer and seller agree on the price. Okay? Now, when there's buying pressure, because short sellers, long buyers, news, act of God, and politics or new projects, or many more, drive the price up. It tilts the scale and drive the price up. There are many reasons, in other words, why the stock will go up or down. And that includes short sellers, right? We're going to go in more details on short sellers, how that happened, right? Long buyers, the news, maybe they say, hey, Apple came out with a new phone and they expect to sell 20 million phones on the first day. Everybody go and buy Apple. So it drives the price down. An act of God, for example, especially, let's say, lumber, and water and food. You get a storm, a hurricane develop in the Pacific, is coming here, or it's up in the Gulf of Mexico, and it's going to hit Florida, and guess what? That's an act of God. But what do you think happened to food and gasoline? Everybody goes and buy gas, everybody going to buy food, and everybody get out of town. They don't want to get caught there. So it drives the price up. And this company that supplies this material, like lumber, right? Because going to be a lot of construction, and a lot of people going to buy a lot of plywood to cover their windows. Home Depot stock goes up. It goes up because an act of God. It's not because the company worth more. It goes up for the fact that the storm is coming and people flood into Home Depot to buy all the plywood that they can to protect their home. Then you get politics. Politicians say, well, we're gonna give an incentive. We're gonna give a corporate tax break. They're gonna pay less taxes. That drives the price up. The company knows where's more. For a period of time, the price goes up because some political decision, right, force the price to go up. New project, let's say that We're gonna have building new highway, so what do you think the people that produce raw iron, rebars, lumber, people gonna get jobs. So all these people that manufacture, Caterpillar, oh man, the government gonna spend $3 billion in a highway on this here, and they're gonna be a nationwide project like the interstate. Well, you're gonna need a lot of bulldozers, Caterpillar, a lot of rebar, a lot of concrete, so Caterpillar will go up, right? If they say, hey, we're going to tax the corporation 20% tax, then the price of the stock will go the other way, right? So this is what drives the pressures of many and many more that can drive the price to go up. This is the balance part of it. Buyers and sellers agree, and we're going to come back into this in a minute. Now, selling pressure. Short sellers. Remember that they're both on both sides of the street, right? Short sellers can drive the price down because the market counts when you sell a stock short, meaning that you're going to sell something you don't have that you borrow from a broker. It counts as a sell, okay? But to cancel that contract, you have to buy it back, and it counts as a buy. So this is what both of them, a short seller, when he sells a short, eventually to get the profit, and to give you a quick example so you don't get confused or think, oh my goodness, this is lesson one and I have to deal with this. Short seller means that, let's say the stock is $100 and you sell it short. It's a terminology used to sell something you don't have. You don't have no stock for sale. The broker gonna lend you the stock to sell it. So you go in and sell it short at 100. You expect the price to go down to 80, so you can make $20, right? So you sold it for 100. In order for you to make $20 at 80, you have to buy it back. When you buy it back, it drives the price up. To cancel this short, to cancel this contract, you have to buy it back. So you can return the stock back to the broker, and the difference, the $20, that's what you're going to make. You got 1,000 shares, you make 20,000. You got 100, you make 2,000. Simple as that. But this is discussed later. But this kind of pressure to explain what a short seller is, that's what it is. So they both, on both sides of it, when they sell it short, they have to buy it back. So short seller coming here, buying it back, the stock that he sold short, it drives the price up. Then taking profit. People that bought the stock themselves over here. People that were buying, the loan buyers. Now they bought it for 100, now 125, and they're going to sell it. So when they sell it, taking the profit, they drive the price down. Then we got news on both sides, right? Bad news about Apple being investigated by the government, and they sold a whole bunch of telephones that the battery exploding and burning like it happened one time. That drives the price down, right? Bad news. Good news drive it up, bad news drive it down. Act of God. Now, how an act of God can drive the price down? Well, one of the reasons that we have seen prices going down recently is because of a virus, a COVID virus, right? But the other act of God that can drive the price down too, floods, can contaminate water. People get sick. A company get caught in a situation that lighting at the plant, and refineries, and lightning hits it and it burns. Nobody set it on fire. It's not arson. It's an act of God. Lighting hit the place. Now, let's say Valero lose one of the refineries, like in Three River. They got about 5 refineries in there. And a fire burns it for lighting and stuff like that. Well, Valero stock gonna go down, right? So it drives price. Politics, Politics also can drive the price down the same way they can drive it back up, and many more. So they both affect almost sell pressure, just about the same thing in a different way can drive the price up. It can also drive it down. Now let's look about this. There's no such thing as a balanced price, right? Market makers, brokers, and hedge fund managers are living in Disney World or Fantasy Island. Just think about this. If the price remain all the time at $100 and all the stocks in the market remain at the same price, there's no price movement. This guy needs to make a living. Remember, they depend on commission and trickery that they use to make money. Lately, they say no commission. Don't believe that. True, they don't charge you no commission nowadays, right? When I started back in 1972, there was $60 commission for every trade. Whether you bought 100 shares or you buy one share, the fee was $60. Round trip, 120. So really what we got here is that the price had to fluctuate in order for them to make money. The way the money is made nowadays is because they tell you, we buy it at 100, but we sell at 102. So they're making $2 per share. Few months ago, you could buy a stock for $5 commission. Whether you buy 1,000 shares or 100 or 500, it was $5. Now they figure out, you know what? We can make more money if we buy and sell on the bid and the ask price and make $2 a share or $3 a share. So now you buy 1,000 shares and they got 50 cents different between the buy and the selling. They're going to make $500 when before they used to make $5. So don't believe that it's free. There's no such thing as buying free commission. The money is made by these people based on the different price of selling and buying. The spread they keep for themselves. So to believe that the price is in balance, it's just like living in Disney World or living in Fantasy Island. In reality, there's not such thing of a long term or for a few minutes the price to remain in balance. So let's look at this as something else right quick so you can understand what I'm talking about. Okay, here we are. And this is the final part of lesson 1 now. I'm going to show you here that here's Tesla, right? And this is December 1st at 9:41 in the morning. The market just recently opened at 9:30, and Tesla is up $16 in here, right? So let's see how this works out. So we are up to $21, and look how quick that price moved. As you can tell, we're coming up in here, and the price, we started at 21, and in a matter of seconds, right? We're barely 37 seconds, and we're down to 15. So in a matter of 45 seconds, we have gone from $21 to $15.74. And this is what I want you to understand, 41 seconds, and we have gone from $21 to 15. That's about $6-7 drop. So you can tell how fast and how quickly price can move. It don't stand still. It just don't do that. It's just that don't happen by accident. That's the way the market works. You don't see that because normally you don't trade by the day, you don't trade by the minute, but I do. So I do see a lot. You normally see the price moving daily. So this is how things move. So here we go, and that's actually what it comes out to be. We hit to $15 in a matter of 40-something seconds. With this, let me give you a heads up for what's coming up. Lesson 2, we're going to start talking about how the stock move in popularity from one end to another, seasonalities. And what really happened is that stocks behave different on different months. And we will continue doing charts and study in more detail one by one. So with that, we're going to have probably a little video, and that's going to be the end of lesson 1. Okay, folks, do appreciate your time for coming to the class, and we'll see you next week on our next part 2. We're going to be on lesson number 2 starting next week, so we'll see you next week. So take care and have a good morning. It's about 11 o'clock and it's 11:15, so it's time to go. So we'll see you next week.